In this week's video, we'll address the question, what advice would Jesse Livermore have for investors in 2017? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. In the slides that follow, we'll be covering numerous big picture 2017 charts in the context of quotes from Jesse Livermore, who is arguably the most successful speculator, tape reader, or investor of all time. From Mr. Livermore, I think it was a long step forward in my trading education when I realized at last that when old Mr. Partridge kept on telling customers, well, you know it's a bull market, he really meant to tell them that the big money was not in the individual fluctuations, but in the main movements, that is, not in reading the tape, but sizing up the entire market and its trend. We know from past videos, in order to size up the entire market, we have to be able to simplify things, and all market profiles ultimately fit into three major categories: uptrends, consolidation, and downtrends. And we also know the concept of market fractals tells us that uptrends, consolidation patterns, and downtrends apply to all time frames. So in order to size up the entire market and its trend, it's prudent for us to do so on multiple time frames. For our purposes, the 50-day moving average serves to help us track shorter-term time frames and shorter-term trends and fluctuations. This is the S&P 500's 50-day moving average here in calendar year 2002. It provides us with an example of the look that we want to avoid. This is what a downtrend looks like. Downtrends move from the upper left-hand corner of your chart to the lower right-hand corner. Same situation during a strong downtrend that we could see, measure, and put in a model late in calendar year 2008 and into early 2009. The 50-day moving average moves from the upper left-hand corner to the lower right-hand corner. How does the exact same chart look in mid-October of 2017? The answer is a lot better. Instead of moving from the upper left-hand corner to the lower right-hand corner, we're moving from the lower left-hand corner to the upper right-hand corner. This is the look that we want to embrace. This is the look that we want to avoid. To monitor the market's intermediate term trend, we can use something like the 22-week moving average. This is the look that we want to avoid in 2002. This is the look of the 22-week during a strong downtrend, 2008 and 2009. How does the exact same 22-week moving average look today? In a word, bullish. This is a bearish look. This is a bearish look. This is a favorable look from a probability perspective. Same principles apply when we move out to 60,000 feet. This is the S&P 500's 50-month moving average in 2002. S&P 500's 50-month moving average late in 2008 and early in 2009. We said we wanted to avoid upper left-hand corner to lower right-hand corner moves. That's not what we have in the present day. We pretty much have the polar opposite. We're moving from the lower left-hand corner to the upper right-hand corner, which is what an uptrend or favorable trend looks like. We've shown the 50-day, the 22-week, and 50-month moving averages for illustrative purposes only. We're illustrating basic concepts. We're not implying that we time the market using these three moving averages. Clients and regular viewers know that the trend strength portion of our model that monitors the health of the market asks 207 binary questions using multiple time frames and multiple inputs about the market's short-term, intermediate term, and long-term health from a trend perspective. On Friday, October 13, 2017, no matter what question we ask or what time frame we look at, are what inputs we use. 100% of the questions that we're asking about the market's health in October of 2017 are coming back favorable, meaning we could pretty much show you the same concepts on any time frame and we would basically draw the same conclusions, telling us that based on the facts that we have in front of us today on Friday, October 13, 2017, the market's trend is unequivocally and unquestionably favorable. And remember, Jesse Livermore told us that the big money was made by sizing up the entire market and its trend. And many of the charts that we've reviewed over the past 12 to 16 months help us do exactly that. Here's one of the charts that we looked at last week. This is the NYSE composite. The longer a market goes sideways, the bigger the move that we can expect to get when we either get a bullish breakout or bearish breakdown. This is also a favorable look. A chart like this also helps us size up the entire market. This is our value line geometric index. It's basically been consolidating or moving sideways in an indecisive manner for 20 years. And market fractals tell us this is consolidation. If this was the look on a 60-minute chart, we would say that the market was consolidating. The exact same concept applies to a multiple year chart. From 60,000 feet and from a long-term perspective, this is the same as consolidation on a 1-minute chart, a daily chart, a weekly chart, or a monthly chart, and it should be treated the exact same way. You can also make an argument that this has a similar look to an inverse and bullish head and shoulders pattern. Here's our left shoulder here. This is our upward sloping neckline, which also leans bullish. Here's the head and here's the right shoulder. The fact that the right shoulder is quite a bit more shallow than the left shoulder is also bullish. As of Friday, October 13th, 2017, this bullish breakout is still holding. The longer a market goes sideways, the bigger the move that we can expect to get. The longer it holds, the more meaningful it becomes. Here's a chart of the NYSE composite dating back to 1965 that we covered last week. This setup here is very, very similar to the setup here. After this look here, the stock market went up for 19 years and tacked on an additional 945%. This type of analysis also aligns with the wisdom of Jesse Livermore. The big money, like 945%, was not in the individual fluctuations, but in the main movements, that is. Not reading the tape, not watching the market too closely, not worrying about what everybody else is doing, but sizing up the entire market and its trend. It's extremely important to understand our goal. Our goal in this type of environment is to navigate from a point A to a point B that could occur several years down the road. The big money is not made reading the tape. Said another way, the big money is not made with a short-term transaction-oriented focus when we have trends like this or this. Here's another chart that we've covered in the past. This is the Nasdaq Monthly 1984 on the left side of your screen. This is the year 2000 on the right side of your screen. The longer a market goes sideways, the bigger the move that we can expect to get. After the bullish breakout here, the Nasdaq tacked on an additional 952% from point A to point B. The longer a market goes sideways, after a 6-year consolidation, the market went up for 9 years. In the present day, the Nasdaq went absolutely, positively nowhere from this point A to this point B. That's a 17-year horizontal line. The longer a market goes sideways, the bigger the move that we can expect to get. We are less than 1 year into this bullish breakout that occurred in calendar year 2016, telling us with the profile that we have in place today, our focus should be on sizing up the entire market and its trend. And when we have a chart like this, sideways movement and a bullish breakout, we can leverage the wisdom of Jesse Livermore once again. I can't tell you how it came to take me so many years to learn that instead of placing piking bets on what the next few quotes were going to be, my game was to anticipate what was going to happen in a big way. Big way moves come after long periods of indecisiveness and consolidation. 952%. We didn't even have to own the best stock. If we owned the index, this is the big move, and this is a big way. This quote here is exactly what we did last week with this chart. A man must study general conditions to seize them so as to be able to anticipate probabilities. As we've said many times, on the right side of these charts, we are not forecasting anything. We are simply assessing probabilities based on how markets operate. Mr. Livermore told us that the big money was not made in tape reading, watching the market tick by tick, but rather focusing on the long-term trend and the big picture. Even if markets move from a point A to a point B that's several years down the road, it's going to be very, very difficult to capture those gains if we cannot prevent ourselves from making these common missteps. Watching the markets too closely, which includes reading every single bullish and bearish article that's published. Watching our profit and loss too closely. Checking our account balances hourly. Focusing on forecast. Watching financial TV. Here are two big ones. Common missteps. If you want to make mistakes, worry about what everybody else is doing and worry about what everybody else is saying. We should be worrying about what we're doing, why we're doing it, and why what we're doing is sound from a probability perspective. Other common missteps. Trying to avoid volatility. Volatility is not the enemy. We know one thing with 100% certainty. If the market moves from a point A to a point B several years down the road, absolutely, positively, there is going to be a ton of volatility between point A and point B. If we want to make mistakes, we should always be fearful of the next pullback. We should always be fearful of the next bear market. If we want to make mistakes, we should talk a lot about what if this happens. If this happens, the market could. It's a form of forecasting. And if we want to make mistakes, we should always have a short-term focus, and we should make decisions based on our short-term fear. None of us want to make mistakes, therefore we have to be aware of these common missteps and make sure we take steps to avoid them. Mr. Livermore was well aware of these demons. A stock operator has to fight a lot of expensive enemies within himself. If we're going to navigate from point A to point B, the difficult part of the job will not be the charts. It will be all of this and the expensive enemies that we have within ourselves. As Mr. Livermore notes, even if this type of analysis is correct and the market moves for many, many years in this direction, men who can both be right and sit tight are uncommon. I found it one of the hardest things to learn, but it is only after a stock operator has firmly grasped this that he can make big money. And if anyone was unhappy making 945% from point A to point B, then they will never be happy in the markets. This is a big money move. The powerful part of successfully assessing the market's big picture is time. Time is our ally. As Mr. Livermore noted, it takes time to make money. In this case, it took 9 years with a lot of gut-wrenching volatility for the market to move 952% from point A to point B. And I might note, the number of trades that were required to move from point A to point B and capture a 952% gain, the number of trades required is basically one. You have to take a position, and then you have to sit tight. Again, for Mr. Livermore, nobody can catch all the fluctuations. We're naive if we think we're going to trade all of these fluctuations between point A and point B. Remember, the big money is not made in tape reading and a short-term focus. The big money is made assessing the big picture, maintaining a longer-term focus, especially when we have setups like we have in 2017. These type of missteps tend to occur when you're worried about short-term fluctuations. The vast majority of the common missteps that derail us between a point A and a point B have to do with worrying about the possibility of short-term fluctuations and trying to trade around short-term fluctuations. There is always going to be a ton of volatility between a point A and point B. That's just a fact. That's the way markets work. Let's shift gears here momentarily to global stocks. This is the global Dow Index. This is calendar year 2001 on the left side of your screen, and the present day, October of 2017, on the right side of your screen. Similar to many major indices that we've looked at in recent months and dating back over a year, we have one of our long-term consolidation boxes and a bullish breakout here. Price entered the box in 2004, went to the top of the box and was rejected in 2007, went all the way down to the bottom of the box again in 2009, and then since then has basically been treading water between this point here and this point here until recently, calendar year 2017, we get a bullish breakout from a long-term consolidation period. And we know that no matter how many people tell you why the market shouldn't be that high or why nothing has changed, the mere fact that price is at a new high tells you something has changed. Therefore, we are bullish and we like foreign stocks. The question is, on our time frame and for our approach, do we like them better than U.S. stocks? The answer is to be determined. We really don't have enough information on our time frame yet. This is the same global Dow index relative to the S&P 500. You can see the ratio peaked in 2008 and was rejected at the blue line in 2009, 2011. It couldn't even make it back to the line in 2014. And we're back to that point again in 2017. And we could draw numerous trend lines here telling us that this ratio, from a very long-term perspective, multiple year perspective, still has some things to prove. We haven't even made a higher high yet over this thin red line here. And you can see from these other trend lines, if we can get into this white space here, then this ratio could outperform and make a run in this direction for a long, long period of time. We like foreign stocks. We like global stocks. However, we, like Mr. Buffett, make investment decisions based on our evaluation of the most profitable combination of probabilities. There's no doubt the probabilities and the charts and the math from a shorter term and intermediate term perspective favor global stocks or foreign stocks over the S&P 500. However, that's not true on all time frames yet, and it's to be determined. Under our approach, we are building a portfolio that will give us the highest probability of navigating between a point A and a point B that could be several years down the road. And we know in advance that it's going to be difficult to navigate between point A and point B. Similar situation here. Our focus is on a point B that could be several years down the road. And we know the market's going to make it difficult even if we just own SPY or QQQ. This is a 19-year period here. If we double back here, the periods of outperformance here are basically months. This is a trade from a long-term perspective. Global stocks outperform, then they underperform. They outperform, then they underperform. Outperform, underperform. And right now, that cycle from a very long-term perspective with the data that we have in front of us today, which may change very soon, still looks like a long-term downtrend favoring U.S. stocks over global stocks. And we can see, measure, and put in a model that this is unequivocally favorable here. But we use the wisdom of Jesse Livermore in this case as well. Mr. Livermore, don't take action with a trade until the market itself confirms your opinion. Being a little late in a trade is insurance that your opinion is correct. In other words, don't be an impatient trader. In this case, we are simply being patient. We'd like to see a little more. We're happy to increase what is now a very minimal exposure. We do own one foreign ETF. We're happy to increase that exposure if the market itself can confirm the opinion. The market's opinion right now is favorable here. From an intermediate and short-term perspective, we just like to see it on a longer-term perspective. If we break out here, we could get a run in a slope like this. So we have an open mind about foreign stocks, and we're happy to add more if the data says do so. Just recapping here, this is our 30, 40, and 50-week moving averages for illustrative purposes only. This is the type of look that we want to avoid, our full-bore bearish look. This is the peak in 2000, 2007. Do we have anything in the present day that looks like we're morphing into or even taking a baby step toward something that's more concerning? The answer on Friday, October 13th, 2017 is no. We still have a full-bore bullish look with blue, the fastest moving average on top, and the slopes of all of the moving averages are up and prices above all three moving averages. And if we zoom in, it doesn't appear that blue is making a run towards green or red. Given what we know today, this is still a constructive look. And as we noted earlier, even on multiple time frames, given what we know today, we still have a constructive look. Back to Mr. Livermore. As long as the stock is acting right, or in our case, the ETF, and the market is right, do not be in a hurry to take a profit. You know you are right because if you were not, you would not have a profit. Let it ride and ride along with it. It may grow into a very large profit. And as long as the action of the market does not give you any cause to worry, have the courage of your convictions to stay with it. Our trading frequency has plummeted this year because the trends have allowed us to hold our positions. This 100% figure here does not eliminate the need for maximum flexibility. However, there's a very, very important distinction. The facts that we have in front of us today are just that. They are facts. And we can make a confident and firm assessment of the probabilities that we have in hand today. The flexible, unbiased, and open mind applies to what might happen next. It does not apply to the hard data that we have in front of us today. These are facts and we can assess them. The flexibility acknowledges that we do not know what these charts will look like in 3 days, 3 weeks, 3 months, or 3 years. And the only way that we can properly see and adjust to a chart that morphs from a look like this into a look like this is if we head into next week with that flexible, unbiased, and open mind. And as noted by Mr. Livermore, If the facts tell us to sit tight, we will sit tight. Remember at the top of the video we said all market profiles basically fall into three categories: bullish uptrends, indecisive consolidation, or bearish downtrends. There is really nothing new under the sun. Greed and fear have been the same for many, many years, and they will remain the same for many, many years to come. So when we see a bullish setup similar to the one that we covered in detail in last week's video, it's very, very important to keep in mind. From Mr. Livermore, I learned early that there is nothing new on Wall Street. There can't be, because speculation is as old as the hills. Whatever happens in the stock market today has happened before, and it will happen again. I've never forgotten that. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.